Hi, everyone. Jim Kruzan here, and welcome to the first quarter's capital market review. Hope everyone's had a great start to the new year. As we do every quarter, we come up with a theme. And the last several of these quarterly reviews, we've found song titles as a way of identifying our theme. I came upon this Sam Cooke hit from 1964, "A Change is Gonna Come." And I thought that that was perfect as we've been watching and waiting for some change, either this soft landing that we're talking about, or base case recession, or a market correction. It's been a long time coming. The verse that's repeated throughout the song is, it's been a long time coming, but I know a change gonna come. Oh, yes, it will. That's kind of exactly how we feel these days. What's happening with the market is, are things getting better? Are they getting worse? What is the data suggesting? And that's kind of what we're going to talk about today. We do these quarterly reviews because we think the economy does matter. It's important to dissect several of these major components: growth, jobs, profits. We'll talk a little bit about inflation as well, and certainly we would be remiss if we didn't include interest rates as well. We do this in an attempt to answer kind of where we are in terms of the economic cycle, and more importantly, where we're heading. If you think about it, that's really the only two things we need to get right. Where are we in the economic cycle, and where is the Fed? Since many of our clients are on the cusp of retirement or are currently enjoying retirement, having an idea of where we are certainly lends itself to better portfolio protection. We want to avoid those big drops in capital. Many of us experienced those in the past. Many of us were working through the last serious recession. But whether you're in a balanced account or growth oriented, these drops can be substantial, and it can take an awfully long period of time to dig out from under. And that's the problem, especially if we're taking distributions from the portfolio to enjoy our retirement. It takes even longer still. So to avoid that, to be cognizant of where we are, certainly seems to be a better approach, a better way forward. Today's agenda is short. We'll talk about four things: the market, the economy. We'll talk about financials, both from the standpoint of the government's balance sheet, as well as consumers. And last but not least, we'll talk a little bit about inflation. We've just gotten new inflation data in just this week, which certainly causes some concern that maybe we're not quite out of the woods yet. I mentioned last quarter, as we see it, there are three things we're looking for, three things that possibly could happen, three possible outcomes. One is this eventually goes into a recession. I know a lot of folks are like, well, gee, we've been waiting for one for such a long period of time. Really no longer than the 08 or the 01 recession. A lot of the data turned really quite ugly several years before. We could get this soft landing that the government certainly is expecting, and the market is certainly pricing in. We need to see some changes in data to suggest that's actually happening. We'll talk about that. We'll look at some of the data to see exactly where we are. And the third thing is, this market has been so narrowly focused. That's part of the problem last year. It was really a handful of stocks that caused most of the gain, whereas the rest of the market has been quite anemic and certainly telegraphing, hey, we're not out of the woods. Things aren't all that great. So maybe the market starts to broaden out here a bit. Maybe we start to see other areas of the market starting to get some excitement beyond those magnificent seven. And if that happens, is it happening because it's truly telegraphing better times ahead, which is typically what you'll see, a broadening out of the market? Or is it just FOMO and an awful lot of people wishing they were participating, but just can't get themselves to invest in big tech. And as a result, they're investing in some of those laggards. And we're seeing some broadening out as a result. So we'll try to touch on those things as well. So let's get right in it. Let's talk about the markets. And here we are. This is a chart of PE ratios, forward PE ratios. The forward PE as of the end of the quarter was nearly 21 times. Current PE is even higher still. That's a very high PE. It's well over a full standard deviation above the norm. Historically, when PEs get this high, we usually see a big reset, a rollover at some point. It's not the highest ever recorded, but it's certainly right in there, and certainly every bit as high as when we had those bubbles just a few years ago, when mime stocks and AMC and Bitcoin and cards and non-fungible tokens, there was this huge bubble developing, and we're just off that pace. If you take a step back and you look at other valuation methods, the CAPE PE, which is cyclically adjusted, dividend yield, price to book, price to cash flow, all of those are quite high, quite expensive by a significant amount, well beyond just one standard deviation higher than norm. And then when you look at yield spread, or effectively earnings yield spread, earnings yield is the inverse of the PE, and you subtract from it AA rated bond and investment grade bond, you get a number. Historically, the yield on bonds were horrible, and the PE on the market was less. So the inverse PE minus the yield was a positive number, which encouraged that the market was cheap and more room for growth. Today, with the 20 plus PE, the inverse earnings yield is 5% or less, and you can get 5 or more percent on a long-term bond. Actually, you can get 5 or more percent on a short-term bond. As a result, that yield now is negative, not a great sign for long-term market stability. If we consider where this growth in the market came from, that's also quite unusual. Last year, 2023, profit margins actually dropped. Earnings actually were flat. Earnings did not grow. When we entered into 2023, earnings expectations were quite high, a 10% improvement in earnings. And at the end of the year, it turned out to be really none at all. But we had a huge surge in market valuation, especially toward the end of last year, because of the hope of 7 rate cuts. Margins increased. The stock market went from 17 times earnings to 21 times earnings. And now we're beginning to see profit margins still under pressure. And now the expectation that rate hikes are rate cuts are probably not going to come to that same extent. We've quickly lost 7 rate cut expectations. We are now down to fewer than 3. And there are actually some Fed presidents now that are speaking publicly about maybe no rate cut at all. What does that do to margins? What does that do to multiples? Probably brings multiples in. So even if earnings are a bit better this year than last year, if multiples come down 20 or 25%, you're going to see a sizable drop in market valuation. The big culprit last year was this huge concentration of performance around very, very few names. If you look at the top 10 stocks by market cap, the biggest 10, really a lot of people talk about the Magnificent Seven, just those 7 names, you'll see the biggest 10 represented over 33.5% of the S&P's market cap. There are 500 stocks in the S&P. We're talking about 10 names that represent over a third of the index value. That's important. It's a cap-weighted index. The bigger the company, the more influence it has. When we look at those names as contributions to earnings, those 10 names represented 25.5% of the S&P's earnings. The other 490 stocks really didn't contribute much at all. If we concentrate even further in the Magnificent Seven for 2023, you'll see on a pro forma basis, the Magnificent Seven represented almost all of the market's earnings, and everything outside of the Magnificent Seven contributed to losses. That's why you saw a very anemic return out of the Dow, small cap, etc. And again, the returns would have been even worse if we didn't see that explosion in value toward the end of last year because of this expectation of 7 rate cuts, because job well done. There are now some concerns. For last year, of those 7, the very best company of those 7 was up 239%. The average was up over 70, and the worst was up nearly 50. So if you just did back of the envelope math and said, hey, the average stock was up 70, it represents 30% of the market. 30% of 70 is 21%. Oh, gee, the market was up 24. I wonder where that came from. We're looking for broadening out. That's one of the 3 things that could happen with this market. We're really not seeing a lot of broadening out yet. I'm seeing it on fringes, which is a plus, and we're positioning there. That's one of the reasons that the account has been growing a bit this year. But really, when you consider the NASDAQ up 8, this is through just a few days ago, the S&P up about the same, the Dow Jones hanging around up just over 1, large cap value up a little bit, 5, that's a solid number. Small cap, which usually leads in all rallies because it is very much economically sensitive. So if we have a healthy economy, that should translate into Russell companies. Not much growth there. And obviously, the expectation of 7 rate cuts is now gone, and interest rates are starting to back up once again. So as interest rates back up, they go up, bond prices go down. So a bond aggregate index is down 3% year to date, and the 20-year Treasury is down 8%. A 60-40 global balanced fund through essentially the first quarter would be up about 1.86%. That's 40% US, 20% international, 40% ag. Our large IRAs that we manage for downside protection, up the same. On an annualized basis, that's actually better than cash. So if we had money sitting in money market, sitting in cash at 5.385%, the likelihood is we're not going to get that for the full year. At some point, if interest rates do start to come down, either because of job well done or a weakening economy, those money market rates will come down quickly. So on an annualized basis, that return would be quite a bit less. But if we took 1.8, 1.9% and annualized that, that return would be well over 6, 7%. So we're holding up relatively well there to alternatives. But it's still a very narrow story. Through the first quarter, NVIDIA, by the way, that was the one company that was up 200 and some percent last year, was up 92 in the first quarter alone. It currently represents a little over 5% of the S&P's market cap. One company represents over 5% of the S&P in terms of value. If you did the math, that means that NVIDIA contributed to a little over 4.5% of the 8+% return that the S&P had. Kind of ridiculous and problematic, and unfortunately a little reminiscent of 1999 and 2000. Since early February, we have noticed in some areas the market beginning to broaden out. We began increasing some equity exposure in those areas where we saw some degree of broadening out. We also became a bit more defensive by increasing our exposure to gold and reducing our exposure to bonds. And as a result, it's helped. We're not getting great returns because we're not chasing those 7 names. That may prove to be a mistake temporarily, but it won't prove to be a mistake long term. At 30 plus times earnings, theoretically, it now takes 30 some years to earn back every dollar of value that you've put into the stock. Hard to support that. In the last 40 trading days, up through just a few days ago, the S&P was up 19 of those 40 and down 21. A balanced account, which is considered by most measures a retirement-based conservative widows and orphans, Goldilocks, not too hot, not too cold type account, perfect for someone retired. We had 19 up days and 21 down days. The IRA was up 28 of those days and down just 12. And of those 12, 5 of the 12, we were actually down on a daily basis, less than 1/10 of 1%. So we are providing quite a bit of downside protection. And again, we're very data dependent in making adjustments as we see data coming in. The economy has shown some growth this last year. We'll get into this a little bit more as well. On a yearly basis, we were annualizing out at something close to 3%. It was probably more like 2.5% for the full quarter over quarter return last year. It's still the case that consumers represent over 2/3 of our economy. When you look at components of the economy, consumers and consumer spending is still a big deal. That in and of itself has some degree of concern. We'll talk about this in a moment. Consumers are becoming a little tired. We're not seeing the revenge spend that we saw early last year. We're not seeing the, what is it, YOLO, you only live once spend, no longer. In fact, a surprising data point came from retail sales over the holiday season. And it was quite a surprise that about 30%, almost a third of all retail sales were buy now, pay later. Buy-go programs, buy low programs, I guess. And there are a couple of companies, publicly traded firms that do this, that allow you to buy something, take the merchandise, and then pay it off in 4 easy payments. God help us if we miss a payment. Interest rates go through the roof, much higher than credit card payments. And typically for a consumer who's stressed out, it might be the only place left to go. When cash balances start to dry up in the banking account, you don't use debit cards. When there isn't any more room on credit cards, where else do you go? The next in line is buy now, pay later. And that shows some degree of stress as well. One of the big reasons that GDP was as strong as it was last year was we ran a $1.7 trillion deficit, a huge amount of government spending. I wish this chart went further in history, going back a few years, because you'll notice typically government spending isn't a huge component of total GDP. And you'll notice that in terms of growth, almost for the full year last year, starting toward the end of 2022 and continuing, that light green area here represents government spending. You don't see government spending as a big component in many of the other years. Coming out of COVID, you did. But this is highly unusual for a market that's supposedly, an economy supposedly in great shape. It's somewhat synthetically produced. And it's a concern because what happens going forward? Will they be able to continue this? Debt levels are quite high and they're continuing to increase. This is now a bit of a discussion about finances and specifically the government's checkbook. Federal deficits continue to rise. They're expected to continue to rise going forward. When we look at current debt, it's well over 100% of GDP, which is really quite problematic. If we don't have an extension of the Trump tax cut, then you would see the budget, or I should say, if the Trump tax cut extends, you'll see an increase in budget deficits as well going forward. This becomes highly problematic. Also, when you look at forecasted deficits, we're actually tracking at an even greater pace. This talks about the 2024 budget. And this talks about the fact that we have a shortfall of about $1.5 trillion, or almost 25% of our budget is unfunded. We're going to have to borrow money for that. In Q1, which again, government year begins in October. So in Q1, we ran through another $1 trillion of debt. Last month, it was reported that also in the last 100 days, we added another $1 trillion to debt. So if you consider the start, we're already exceeding this projection by a sizable amount. I mentioned that consumers are 2/3 of the economy. And that's important because we are beginning to see some degree of weakness. Debt service as a percentage of household income is beginning to rise. It's not like it was in 2008, but again, we're not in this recession yet. It's already increased quite a bit. You're seeing also delinquencies. Credit cards, 8.5%, I round up, we'll call it 10% of credit cards outstanding are 30 days delinquent. The only thing that isn't delinquent are student debts, which, by the way, is 8% of total liabilities. And that's because we're on the special 1-year moratorium where if you don't make your payments this year, it won't affect your credit rating. And that goes through October. After that, it does, and we'll see what happens at that point. But again, we're at points that we were at before we slipped in the big recessions. And these numbers already are quite heightened, considering the fact that we're not in a recession. Part of the reason for that is a couple things. One, savings rates. This is personal savings, this blue line, really quite subpar, considering. And the amount of excess savings, all that money that came raining down from on high is now getting diminished. And soon there won't be any of that left. So that'll put the kibosh on a lot of additional consumer spending. What's really interesting is, let me see if I can go back. Yeah, what's really interesting is look at this point here in terms of delinquencies, auto loans, credit cards. They were kind of at a trough that happened to be 2022. Keep that in mind, because when we look at the peak in all this excess money, all this money that came in from the government, special programs, checks that were sent direct, that was also the peak. And now we're seeing this correlation as this goes down, delinquencies go up. One would expect that if it continues this way, it'll get worse before it gets better. We are also beginning to see a little bit of weakness in the job market. It's been somewhat resilient. Again, uncharted territory, I guess. We We never saw a government shutdown. We've never seen the impact on employment that we've had the last several years. So these lags tend to be a bit longer, but you're beginning to see a lot of people now not so willing to quit a job ahead of time. Job openings are also beginning to plummet. All the things you typically see before layoffs. We eliminate job postings, we eliminate positions, and then we have to re-engineer org charts and eliminate people directly. One of the problems that we have now that we didn't have, and actually the probability of a recession starts to creep a little bit higher. We're seeing that on the fringes, only because we're beginning to see this slight uptick in inflation. And as a result of that, it's going to make it very, very difficult for the Fed to cut rates or cut rates as much as they wanted to. Chairman Powell has been very clear on a number of occasions. He doesn't want to be considered in Arthur Burns, who is the Federal Reserve chair before Paul Volcker. He'd rather be remembered as a Paul Volcker-like chairman, and Arthur Burns made the mistake of keeping rates elevated, then cutting rates under political pressure, rekindling inflation, caused a huge, painful double dip recession in the very early 80s. And more importantly, it required Volcker to raise rates to 14% to kill it off. Not saying that we would ever see that again, but certainly it jeopardizes the expectation that rates will not get any higher than 5%, which clearly the market is expecting they're going to come down and come down quickly. Even the Fed still expects that rates will come down. If you look at the FOMC's projections over the course of the next year or so, and the market's projections, they're expecting well, that would be something like 3 rate cuts, 3/4 of a point, taking interest rates from 5.38, which is where they are today, to something like 4.6 over the course of the remainder of this year. This higher, stickier inflation becomes somewhat of a problem. It is certainly suggesting that we won't see any rate cuts anytime soon, because that tends to accelerate inflation, which is hugely difficult to get rid of. As far as other data, things that are predictive of slowdowns or recessions, the LEI, the leading economic index, has always been one. We are also looking for change. We're looking for kind of second derivative change. And one of the reasons that we also increased our market exposure since the early part of the year is we've begun to see a little bit of improvement here. The chart doesn't look like it. It's a huge drop in LEI, and a drop like this has always coincided with a recession without fail. What we did notice right here this last month, the LEI for the first time in 22 months didn't drop. It didn't get worse. In fact, arguably, it was up 0.1%, coming off of a 0.4% drop, followed by another 0.2% drop. We had a very similar situation up here well over a year ago. So we'll see if this trend continues, and if it does, it would certainly encourage us to increase some market exposure. But we are a little bit concerned about bonds and where interest rates are and the effect it has on the market. So we still want to remain cautious. We like the fact that we were up 28 of the last 40 days, in spite of the fact that the market was up 19. Another thing that typically suggests economic recession is this inverted yield curve. Here's where we are through the first quarter. It's actually more inverted than it was, let's say, a year ago. And both of those don't look anything like a normal yield curve. Simply put, banks typically borrow money at the short end and they lend it to the long end. If they're borrowing at the short end and lending it at the long end, gee, there isn't a lot of profit margin there. Borrowing at 5.5 and loaning out at 7 in a mortgage, they don't have enough profit to cover their margins, cover their operations, or cover a contingency that not everybody's going to pay them back. And as a result, they stop lending or make it difficult to lend. And that ultimately slows the economy down. The fact that this is now one of the longest inversions in history doesn't help. Also, the fact that the longer the inversion, the longer and deeper the recession typically is, also doesn't help. Here's where we are right now with this inversion. Still quite inverted. Here is an inversion and a recession. Here's an inversion and recession, inversion, recession. Double dip recession in the 80s. By the way, last time we really had to deal with this inflation, this issue. All these others, the Fed didn't have to worry about inflation. They could cut rates very quickly. Not so much here. This is the issue that we have. We had an inversion. It rewrote. We were in a recession. They then cut rates. We got inflation again. It inverted. Another recession. And it was a very long sloth to get out of that. And here we are today. Historically, the recession happens not when this thing inverts, but when it rewrites. That's an implication that interest rates are starting to come down because the economy needs some help. And the recession happens almost instantaneously. Another thing to consider is this unemployment, still really, really low. Quite strong, much stronger than most would have expected. But unemployment is not a predictor. Typically, unemployment rates are really quite low going into a recession. Some of you have already seen this slide, but Claudia Sahm, who was an economist with the Fed, created this tool which helped to make unemployment data a bit more predictive. And it has more to do with rate of change. What she said is, let's take the last 3 months moving average of the national unemployment rate and look at the low print on unemployment the last 12 months. And if that spread is 0.5% or more, it always triggers a recession. So what we're looking at is a chart, the blue line, of that spread. Look, when the economy shut down because of COVID and everybody was unemployed, the spread between the average of the last 3 months and the low blew out. It got to 9% or more because we had double-digit unemployment. But if you look just before every recession, as the blue line expands, it increases about 0.5% between 0 and 1, and then we're right on the cusp of this recession. And here we are today. Close. Just something to consider. So as we close this episode, this quarter, just want to let everybody know, hey, we remain observant of change. We will react to change. And we certainly continue to remain data dependent as change is coming. We just don't know what it will look like. And once again, we do this because we need to get two things right. We need to know where we are in terms of this economic cycle, and we need to know what the Fed's doing. If there's anyone out there who would like to have a conversation with us, who would like to have a second opinion on where they are, especially as all this relates to healthy and secure retirement, they'd like to know how retirement ready they are through our eyes, we'd love to have that conversation. Simply reach out to us, have them reach out to us at our website, or simply give us a call. We do work through this evolutionary wealth process, which is a sequence of meetings and data and reports, which we think helps to keep everybody on track. I'd also remind you of our podcast, The Retirement Engineer. your path to a bigger, bolder retirement, please check it out. We've had a couple of great interviews. We had one just recently with one of our team members regarding mistakes on required minimum distributions. We've interviewed an FBI agent regarding data security, cybersecurity, in an effort to keep you protected. And we had a woman on who's an expert in assisted living, long-term care, and all the resources that are out there to help you, maybe help aged parents or help your children in decisions they may have at some point in the future. Any questions? We'd love to hear from you. Again, reach out, call us, or reach out by web. And as always, thank you for your trust and confidence over all these years. I'm Jim Kruzan. We'll see you next quarter. Take care.